I'm in front of an European painting here, which is one of Mr. Raymond's collections. For the sake of my presentation, I'm going to pretend that is mine. First of all, where did I get this painting from? Say I got this from Sotheby's auction house. So I have to pay a commission fee to Sotheby's auction house, which can be as high as 25%. And now that I live in Australia, I have to ship this piece of painting to Australia. There's cost of shipping, there's cost of maintenance, there's cost of insurance. The costs involved in paintings are high. And why did I buy this? Just like any other investors or art lovers, I am motivated by two main reasons. For pure love of painting or for investing purpose, or for both of them. Because there are two reasons, two returns are produced. Cyclic return and financial return. For cyclic return, see, I hung this painting on my wall and my house looks better. That's one kind of cyclic return, and I have the visual pleasure. This is another kind of cyclic return as well. And the financial return is easy to understand. So I got this painting for $3,000 and I sold it for $10,000. So the $7,000 here is my financial return. Of course, I have to less all the costs. It is easy to measure financial return. How do we measure cyclic return? And there's a popular way which is called the willingness to pay a rental fee. Say if a family come to me and they want to rent this piece of painting for 3 months. Because after 3 months they are moving out of Australia, so they only rent this piece of painting for decoration purpose or for its service or for the visual pleasure. So the rental fee that they pay can be viewed as the price of cyclic return in dollar term. Now the risks, of course, for this particular piece of painting, you have to keep it from fire or keep it from water, i.e. all kind of physical risks. And another main risk for paintings is people's taste or the current fashion trend, because it changes a lot. So the price of paintings changes a lot as well. Put aside all those risks, there are good things about paintings. They are hard assets, so they are protected from inflation, and they are against currency risk because they always stay at the true value. What about the markets? For European paintings, markets are small in Australia, which causes liquidity problem. In addition to that, the heterogeneity problem of paintings, which means there is only one real piece of each painting. The longer term of investment horizon, the unregulated market. All of this suggests that investing in paintings costs liquidity. On average, I should sell this painting in 10 or more years because that's the average time of paintings to appreciate in the future. Even if the price of this painting rises in 3 years, say to $5,000, and I gain profit, yes, but the transaction costs are high, so it's not worth it to sell this painting in such short term. How do I sell it then? 80% of the investors sell their paintings through auction houses. Once again, you have to pay commission fee to them. Now, how do auction houses price paintings? They basically refer to the records of the price of this painting sold in other auction houses, and they hire experts to price this painting, and they keep track of every painting that is sold elsewhere. Then they come back to reappraise the paintings based on the recent information. Of course, they have to look at these pricing factors here: the supplies of the painting, of this kind of paintings, how famous the painters are, the condition of this painting, and the reputation of the auction house, even the auction location. Of course, the fashion trend and the rumors related to the paintings or to this auction house. In theory, we can use Capen to capture the returns in general of paintings. However, it is not useful in real world. In theory, people use Capen to price anything, and it's the same with paintings. Here's the equation of Capen: the return on an asset, the risk-free rate, the market beta, and the market premium. Of course, we have to plus alpha here. Now with stocks, alpha being the abnormal returns, And with paintings, alpha can be viewed as the cycle effect or the cycle return. Now, because there are two kinds of paintings involved with paintings, which is consumption return and investment return, we only have to capture the investment return in dollar term. How can we do that? We can just include a beta zero factor here, which is a function of the overall return on paintings less the consumption value here. Therefore, we can get the investment return using this equation. But that's not enough here. We also have to include an inflation factor in our campaign model. B here is just the inflation hedging ratio and multiplied by the errors in price expectation in the future. Through study, we found that paintings has an inflation hedging ratio of 1.76, which indicates it is inflation against completely. And about the beta of paintings, it is 1.15 compared to stocks market. And we can see that it is slightly higher than the market because paintings are subject to people's taste and fashion trends. Therefore, it is more volatile than stocks market. Now, we all know that campaign in the real world doesn't work because of the unrealistic assumptions. It is the same with paintings. Although we can use campaign to estimate the general returns on paintings. I am an investor who invests in both stocks market and paintings market. During GFC, I lost a lot of money in stocks. Therefore, I want to cover my loss by selling this piece of painting. And by selling this piece of painting, I have to lose value because of the liquidity problem of paintings. Not just me, any investor who invests in both stocks market and paintings market will do the same. Therefore, during GFC, a lot of paintings suddenly show up in the market, so the price of paintings were driven down. Therefore, ignore the low correlation between stocks market and paintings market. They crashed down together during GFC because there is wealth link between the two investments. How can we use paintings to enhance our portfolio then? The study by Worthington and Higgs, they look through the 8 paintings market, which are 19th century European paintings, contemporary master paintings, and so on. They use a naive strategy, which means they invest equally across 8 markets. By combining them together, it moves closer to the efficient frontier, which suggests that for art lovers whose portfolio is mainly consists of art investments, as we can see above, the diversification benefits are obvious, and their portfolio are almost completely hedged against inflation and currency risk, and their cycle return is higher compared to those investors, and they only have to pay a small amount of taxes. But not everyone is an art lover. The correlation between stocks market and paintings market is only 0.3% by Bryan's research, and it is even negative 1.6% with government bonds based on Compel's figures, and it seems to be it is a good diversification choice. And based on Compel's study here, he include art into a portfolio which consists of S&P 500 and government bonds. The overall return of this portfolio is improved by 0.37%, and the standard deviation drops by 1% by including art in the traditional portfolio. Another study by Worthington and Higgs, they include art into a more complex portfolio, which consists of 5 major conventional investments for investors. And they found art is so far away from the efficient frontier with a high risk and low return. So the diversification benefits by including art into a more complex portfolio is limited. The implications for investors, because art investments has a strong wealth link with stocks, they fall together. So one should not rely too much on art, and diversification benefits by including art into a more complex portfolio, which almost every investor holds, is not too much as we thought. It could be the liquidity problem. It could be the inefficient market. And what can we do? Use paintings. Well, we can use paintings to hedge against inflation. We can use paintings to protect ourselves against currency risk because they're hard assets. They always stay at their true value. And we can use paintings to decorate our houses. This is kind of a cycle return which stocks don't have. If I am less risk averse, I should invest in 19th century European paintings, which provides high return and high risk as well. And if I am more risk averse, I probably should invest in contemporary masters paintings market, which has a lower risk and low return correspondingly. And another thing we can do is invest in fine paintings market. It provides high return and less risks compared to art index by Bryan's research, and it provides higher diversification benefits. However, it requires a large capital than invest in indexes.
Anyway, that's all right.
Yeah. In the academic world, people use CAPM. If you have heard of the capital asset pricing model.
Don't know anything about it.
Yeah, it's an academic tool to price paintings. Well, in my personal view, it's unrealistic.
It is. It's unrealistic. Because as I said to you, 80% of the paintings are bought at auction.
You bought at auction? 80%?
People buy at auction. The dealers.
Okay.
I buy at auction. And I can look up this book and it tells me a price, approximate, but if two people want the painting, it could bring
Price up to the sky high.
it's personal taste, you know.
Is there any model or methodology that can be used to price paintings that people use?
That's what they use. They use ArtNet on the internet, which has all the prices recorded for all the artists.
In auction by auction houses?
That's correct, all over the world. So you can look up that artist, right?
Yeah.
And you can get an idea of that size, how much he's bringing. Understand?